morning, everyone, and welcome to our webinar, Medicare, Medicaid, and Long-Term Care Insurance with Ames Mike Anderson and Mutual of Omaha's Bill Beckett. Today's webinar will be recorded and then later posted on our website. This does mean that all attendees will be automatically muted so that we get a quality recording. If you have any questions, go ahead and type them into the chat box and we'll try to answer them throughout the presentation. But if we're unable to get to all the questions, we'll have a member of our marketing team reach out to you individually to make sure you get that answered. Before we get started, we'd like to invite you to join us for our next webinar on Tuesday, April 8th at 9 a.m. Pacific Time. Join Regional Marketing Director Derek Lape for Affordable Care Solutions, the Power of Short-Term Care Insurance. And with that, I'll hand it over to Mike so that we can go ahead and get started. Take it away, Mike.
All right. Thanks, Jordan. Appreciate everything you do. Jordan does a great job with all of the behind the curtain stuff. She's kind of like the Wizard of Yakima for us. She takes care of all the technology things, including what's most important for agents, to be honest with you, is handling the recording and getting it posted up to our website so that agents can circle back and re-listen to things along the way. So appreciate all that, Jordan. We are really lucky today to be joined by Bill Beckett and Maria Laura Rivas from Mutual of Omaha. Maria is our account exec for long-term care. She's been a great friend to AIM for a long time. She's been a great friend to our agents because she's got access to so much information and does such a great job with what I would generally would refer to as problem solving and helping us with problem solving to take care of these agents along the way. So good morning, Maria. We appreciate you being here, and we're always appreciative of what you do. Bill Beckett is he's a 10-year veteran at Mutual of Omaha. He's been with the Advanced Markets team for a little bit more than 3 years. We really like working with the folks in Advanced Markets because they do all the serious, heavy thinking stuff and pull these great presentations together for us, and they have just a different perspective kind of from the inside of the jar than what we do on things, and frankly they can commit time to pulling these things together. And we really felt like, and this will be part of what we talk about during the course of the program, with all of the stuff that you're hearing out there about everything that's going on in Washington, D.C., a real understanding of how these pieces work together and maybe more importantly, how they don't work together, and dismissing some of the urban legends surrounding all of this was an important thing for agents to have a bit of a refresher on as we go forward. So with that in mind, I'm going to go ahead and turn it over to Bill, and he's going to take us through this. I'll be jumping in from time to time with pieces, parts of stuff, and we think it'll be worth your time. We appreciate you joining us here this morning. So Bill, you go ahead and take it away.
Yeah, thanks, Mike. Appreciate it. Jordan, thanks as well. And yeah, hi, everybody. Thanks for having me today. Thanks for joining. Mike alluded to it, right? A lot of urban legends going around when you talk to your prospects and clients about long-term care coverage with respect to Medicare and Medicaid. So we'll jump into it. We'll take a look at it, hopefully give you some clarity around it, and really give you some talking points too when you're meeting with folks out there. So let's start with this. You probably get this on a regular basis. We don't need long-term care insurance because Medicare will pay if we need long-term care, right? So first off, just maybe for some of the newer folks, Medicare, Medicaid, they sound awfully alike. Medicare is the federal health insurance program for people that are 65 or older, right? When you look at your paycheck, there's the FICA tax coming out of it. That's what's being used to pay for Medicare. Again, for folks 65 and older. But you probably get this a lot. Oh, I'll get my long-term care coverage through Medicare. In fact, this was a study done in 2023, about a little over a year ago. 45% of adults aged 65 and older actually believe that Medicare would cover or will cover long-term care costs. And if you look over to the right of the screen, I pulled this right from the Medicare.gov website, and I won't read the whole thing to you, but I'll just read Medicare and most health insurance, including Medicare supplement insurance, don't pay for long-term care. And then it goes on to say, you pay 100% for non-covered services, including most long-term care. So what does Medicare actually cover? And I'm going to try to relate it, then we'll go through everything it covers, but try to relate it to long-term care. So Medicare will cover 100% of skilled nursing care for 20 days. For days 21 through 100, the participant would pay a daily co-insurance. By the way, that's expensive. That's over $200 a day. Medicare will pay for short-term in-home skilled nursing care. They'll pay for, durable medical equipment, walker, wheelchair, things like that. And they'll also pay for hospice care. But let's digest this a little bit more. Notice I underlined the word skilled a couple times in this slide, because Medicare will generally pay for skilled nursing care. So skilled care involves, think of, traditional therapy, nursing for rehabilitation, right? So in other words, maybe you get a knee replacement, right? After the surgery, you need some time to rehabilitate and recover and get that knee working again. That's skilled nursing care. That would be covered by Medicare. Long-term care, when you think of long-term care, don't think of skilled care, think of custodial care. Custodial care is, I guess the best way to think of it think of it as it's generally, non-medical assistance, right? So think of the daily activities, the ADLs, bathing, dressing, eating, using the bathroom, watching over somebody, throughout the day, throughout the night. That's custodial care. So Medicare generally does not pay for custodial care. It pays for skilled care. The other thing I want to point out is the very bottom, hospice care. Medicare does pay for hospice care, but to be eligible for Medicare hospice benefits, the patient has to have a terminal illness with the prognosis of 6 months or less. And this is a big one. That individual must choose comfort care instead of, they call it curative care. So in other words, the patient has to say, I don't want to be treated to try to cure my terminal illness. I want comfort care to, for the end of my life. And again, it has to be 6 months or less. So that's what Medicare does cover. So,
Bill?
Yes.
Yeah. Flip back to that slide real quick, would you?
Yep.
An important part of this whole equation right here, and there's been a massive amount of gymnastics that goes on with Medicare and with hospitals and such about this, is this 3-day hospital stay. Okay, and there's been, the amount of effort that Medicare has put into making it more and more difficult to meet that 3-day qualification. Those gymnastics would qualify you for the Olympics. Okay,
yes.
And that's and what's happened is they've created confinement status and they've created observation status, and this has really forced what we do into a cottage industry within the scope of hospital indemnity products, because they had to adapt their language to take care of actually paying for confinement, paying for observation. But what happens is when your client is in the hospital for 2 days or 3 days and they're only under observation status, in most cases, they're not going to meet that 3-day requirement because it's an inpatient stay. And so all of this happens on the part of Medicare to try to keep from hitting that trigger, which would make available that skilled nursing care after that 3-day stay. And it's all behind the scenes. You just hear the comments from a frustrated client about how this didn't happen, or they've got this line item on their EOBs and these different kinds of things. Really important to remember that less than 0.5% of the people that need long-term care services, meet that 3-day requirement right there. Okay, so that shows you just how difficult it is and how much threading of the needle goes on with that. And twice in the last several years, Medicare has changed the criteria for this. One of them was back in 19 when they went to this patient-driven payment model on these kinds of things. And then in 2024, they got in once again and further clarified observation status and what the different pieces, parts of that is. So my point with this is that it's a very complicated puzzle that has to be put together, or like I said, you're trying to thread the needle in a windstorm to make this whole thing happen. So I think it's helpful for you when you're talking to clients and they're asking questions about these kinds of things to kind of have that context. The number is pretty close to infinitesimal in terms of the opportunity they're going to have to get into that spot. So thanks for that, Bill. I'll go ahead and let you go back to what you were doing, regularly scheduled programming.
I tell you, that is a great point. And you think about it from a real life perspective, one of your loved ones is in the hospital and they get discharged and they don't qualify for skilled nursing care. What happens then? I mean, that's, you put everybody in a tough position. All right. So we talked about Medicare, and then, a lot will probably say, okay, I agree with you. Maybe Medicare will not cover my long-term care. I'll just self-insure. Well, let's take a look at that. So, and I put this up here, and not to be funny, but I wrote, self-insure or self-deceive. And by self-deceive, what I really mean is that, a lot of times it's just human nature. When you're thinking of things that haven't occurred yet, things in the future, a lot of times it's easier just to bury your head in the sand, if you will, right? And say, oh, everything will be fine. When I get to that point, I'll just self-insure. I'll pay for it. Probably need to gather more information before somebody makes that decision. So take a look at this. On average, a 65-year-old couple can expect to pay $335,000 for their health care when they're in retirement. And by the way, this is $335,000 in healthcare cost, not just long-term care costs. So this also includes folks that never use long-term care. What I'm trying to do is just show you how expensive just healthcare costs are for retired folks. Now, the same group of people, when they ask them, hey, how much do you think, as a couple you'll need in retirement for your healthcare costs? The average came out to be around $75,000. So the reason I tell you this is we don't do a good job educating, our seniors and, people in their 50s and, starting to mature up into the, getting ready for retirement. We don't do a good job educating them to give them an idea, hey, this is how much just healthcare will cost you in retirement. So then you add long-term care, and there you may not have the funds to do it. So self-insuring may not always be the best option. So as you're talking to a client and you're still talking self-insuring, right? They'll say, oh, but hey, look, when I retire, a lot of my other expenses will go away. Well, let's talk about that. So a little less, so about 41% of homeowners over 64 have a mortgage. So that means retirees, a lot of retirees actually have a mortgage. But here's the interesting thing. It was about half of that, just their generation earlier. So you can see debt load is really starting to pile up more in seniors than we've seen in the past. Here's a big one. 71% of retirees have non-mortgage debt with a balance of near 25K. Think of car loans, credit cards, things of that nature. Interesting thing about this is that number is actually increasing really, really fast. And you probably read about it or seen it in different places, right? Bankruptcy amongst seniors is growing really fast, and the number one reason is because they're taking out debt to pay for a lot of times medical costs, to include long-term care. Only 7% of workers have pensions now, right? Our parents had pensions, right? It was a little bit more common. unless you work for the government, pensions are a thing pretty much of the past, not completely, but not a lot of workers have pensions anymore. The last bullet, you guys probably hear this a lot. You're talking with somebody and they'll say, oh, when I retire, I'm going to be in a lower tax bracket, so I'll have more money. Well, maybe, but maybe not. Think about it. What are the three biggest items that we can deduct if you don't do a standard deduction? If you itemize, what are the three biggest deductions that you have? Well, the first one is children, right? I mean, in fact, children's not even a deduction. That's a tax credit. That comes right off the top. You get that in your, when you're younger, but when your kids become of age, you can't deduct them anymore. You don't get the credit, even if they're still on the payroll, right? Your payroll, you don't get the credit for them anymore. So that's gone. Number two is, when you're working, you contribute to a 401k most likely. Well, when you're retired, you're not contributing, you're taking out. So that tax deduction's gone. And then the third biggest one is often, mortgage expense, right? And a lot of times the mortgage is paid off, if not a good balance of the mortgage is paid off. So if people tell you, oh, when I retire, I'll go into a lower tax bracket, that might not be the case. All their deductions and credits may be gone, so they may not have that extra money that they think they have. So we talked a little bit about self-funding, and hopefully we identified some myths, or at least talking points. Self-funding can get very, very expensive, and a lot of times the funds that you think you might have in retirement might not actually be there because other medical expenses are higher. You may not be in that lower tax bracket you think, a lot of reasons. So you may run into this, no problem, I'll just go on Medicaid and let the government pay for my long-term care. So we talked about, Medicare, right? That's for people over 65. Medicaid. So Medicaid they're state programs, but they're funded with a lot of federal money as well. But Medicaid helps cover medical costs for people with limited income and resources, right? Sometimes it's referred to as the welfare system. So a lot of people think, hey, I'll just go on Medicaid and let the government pay for my long-term care costs. So let's take a look at that. So Medicaid looks at two criteria. They look at your assets. So, how much do you have, right? Think of stocks, bonds, checking accounts, savings accounts, houses, cars, right? Property. Then they also look at your income. Those are kind of the two things you look at. So here's some asset rules for Medicaid. If you go on Medicaid, generally speaking, one thing I will say about Medicaid is that the rules are very, very state specific, right? So I'm talking general, but they all follow standard rules. It's usually the amounts that are a little bit different. Generally speaking, you could go on Medicaid and you could keep your home while you're living in it and still alive. That does not mean after you pass that the government will then go and take your home, from your beneficiaries or your estate, but you could live in it. You're allowed generally one motor vehicle. If you're a small business owner, you could keep some of the property like machinery and equipment if it's vital towards the business, and you could keep a irrevocable burial fund, right? For your funeral. But here's the important part. Let's look at the assets. Again, every state's a little bit different. Here's what you could keep in addition to what I just mentioned. $2,000 in countable assets if you're single, $3,000 in countable assets for married couples. Oh, and if you have, additional family members, great news, they'll let you keep, $25 for each family member. So not a lot. That's not much at all. This is what you have to kind of draw down to just to qualify for Medicaid from an asset protection, from an asset qualification. And again, all states have their own rules and limits. And Mike mentioned it earlier. on the Medicare side, hey, it's really hard. It's, I think he said it really good, like, threading a needle. Medicaid is the same. So Medicaid is really interesting. Medicaid, for just about every state, in fact, it probably is every state, is the largest single budget item. And it is really starting to run out of control. The costs are escalating, and states are trying to figure out how to put caps and limit the spending. Medicaid is not easy to qualify. A lot of times there's long delays in there, things of that nature. So Medicaid, like Medicare, is also not the easiest thing to get. So we just looked at the asset rules for Medicaid. Now let's look at the income rules for Medicaid. And again, these would be the income thresholds that you would need to meet to qualify for Medicaid. So single applicants, the income is generally around $967,000 to $1,300 a month. Just so you know, why is the difference? Some states use the SSI federal benefit rate. Some states use the federal poverty level, and maybe they put a multiplier in there. So, but regardless, that is not a lot of money. For married applicants, maybe they're both applying for Medicaid. It ranges from about $1,700 a month on the high end, $1,400 a month on the low end. A lot of times people say, oh, well, only, we're married, but only one spouse is applying. Generally speaking, the same rules apply if it's two spouses applying. So not really, the income rules are low, right? You can see, as I mentioned earlier, Medicaid is really meant for people with limited income and limited resources. And by the way, if you're curious on exactly what the rules are for a specific state, there's the website down there, medicalplanningassistance.org. And there's a few other ones, but they lay it out pretty nicely. So we looked at those income limits. I just want to put something in perspective to you. Let me just go back. So single couple, single individual, about $11,000 to $1,500 per year. Social Security benefits on average for 2024, $22,000, almost $23,000. So if you're just at the average Social Security, you already don't qualify for Medicaid. And Social Security benefits are countable towards income qualifications for Medicaid. Some people say, well, I'm sure Social Security doesn't count because, sometimes Social Security is not taxable depending on your income level. It does count for the Medicaid qualification test with respect to income.
Hey, Bill?
Yes.
I want to jump in here real quick. If you'll flip back to that slide. You guys just saw the same slides that no, that's right. That's perfect right there. You just saw the slides that I saw that Bill had. To give you an idea of awareness of this away from your clients, institutional awareness of this, there have been efforts ongoing now for 17, 18 years to try to take steps to ease up the burden that long-term care costs put onto state Medicaid programs. Going all the way back to 2008, something was created in the long-term care space called the partnership. And the partnership was set up to be a dollar-for-dollar asset disregard. So if your client had a $200,000 policy and they used it, it would allow them to protect $200,000 of benefits from Medicaid qualification. Most recently, and I know there's a lot of folks that are on this call today from the state of Washington, most recently you had that payroll tax initiative in the state of Washington, and we know now that about 25% of the other states are eyeballing something to try to, essentially, you can take away all the pretty language and all this other kind of stuff. What they're trying to do is save Medicaid in their state and keep their state from going bankrupt. That's how severe this issue is. It's not an issue that any one of you can stop or save or really have anything other than a one-person difference to, but just understanding how severe this is and how misinformed any thought process about allowing these institutional things, or they get called entitlement programs, even though so much of it's funded by our own money anyway. And there's a lot of consternation about what is and isn't happening in on a minute-to-minute basis in the nation's capital. But that's how significant these states see this problem as being, and it's not going to go away anytime soon. So go ahead, Bill.
Yeah, that's a great point. Like I think you said it right. Like about 28% of the states have some sort of legislation introduced to do something similar to Washington State. And it's interesting. Like if you look at the Washington State one, then a lot of the proposed legislation in the other states, some of the if you went under, I'll use Washington as an example. If you use that payroll tax, and then we're under the Washington program, it's only like $100 a day that it covers, and you're like, oh, that's really not the best program out there. And I agree, it's not. To Mike's point, the states are looking at it as, hey, we're not trying to provide this great long-term care coverage. They're trying to trim the budget on Medicaid costs. So another reason, if you're in a state where there is legislation pending where they may start a payroll tax program, even more important, have conversations like you want to get your own policy. You don't want to participate in that one. So getting back to Medicaid, you've probably seen, or maybe even people have said, oh, well, there's these special Medicaid, types of Medicaid, sometimes it's nursing home or institutional that they have in my state. So even though it's not regular Medicaid, I'm going to go on this one. This page I have up happens to be the one for Georgia. I'll tell you, like we mentioned before, the states are all similar. So they have a nursing home Medicaid program, and if you look at it there for a single person, the income limit is $2,901. Again, this is Georgia. You go, oh, that's a lot better than the $967, right? It's triple that. It is, but notice there's an asterisk. And by the way, I took this right off of the medicalplanningassistance.org website. So look at, there's an asterisk next to it. Let me read you the asterisk. All of the beneficiaries' monthly income, with the exception of personal needs allowance, which is $70 a month, Medicare premiums, and possibly a needs allowance for the non-applicant spouse, if there's a spouse, must be paid to the nursing home. This is called patient liability. So if people tell you, oh, I'm just going on, the Medicaid nursing home program, talk them through it. Don't be confused. When you look at Medicaid, there's a couple things. One of them is you just, the first hurdle is you have to qualify, right? So all this is doing is raising the bar, or maybe lowering the bar a little bit. So it's a little bit easier to qualify from the income perspective, but still not a lot of money, right? I mean, we just looked at what Social Security pays. That doesn't mean that you get to keep that money. Once you go on Medicaid, they may, provide you assistance, but they are still going to take a lot of your funds. It says it right there. So make sure people understand that that's how this program works. It just, allows you to get your foot in the door for Medicaid, but they will still take a lot of your income and a lot of your assets. And then the question is, do you really want to be on Medicaid anyway? So I heard I can do an asset protection trust and keep my assets and still getting Medicaid, right? So there are trusts out there that you could put assets into it and you could still get Medicaid. And there's also different ways. Sometimes you'll maybe transfer assets to, like an adult child or things like that. So there's different ways to do it. So let's talk about the downsides of this. You can, but you no longer control your assets. To do this, you have to make irrevocable, usually they're called gifts or transfers. You give up control of that asset. There's also generally a 5-year look back window. So if you do it and 4 years later, you have to go on Medicaid, guess what? Everything you put into the trust or gifted to someone else is coming back and Medicaid will take it. Income you receive from the trust is countable, so that may go away. Higher net wealth clients, I won't get into a lot, but they could have estate recapture issues later on. If this works, right? If you go and you hire an attorney and you set up a trust and you get all your assets transferred over, at best, you're on Medicaid. Do you really want to go through all of this just so you can get on Medicaid? The other thing is, it's, depending, lawyers aren't cheap, right? So you have to spend money to do this. I'm not saying this is a bad idea, but every case is unique, and sometimes there are better options than other options. The other thing I want to point out, again, right now we're talking about assets. What do you think the biggest asset for most retired people is? And I'll give you a hint, it's usually not the house. They have a bigger asset. That's usually the retirement account, like their 401k, maybe an IRA. Guess what? You cannot put a 401k or an IRA into a trust. The only way you can do that is you actually have to cash out that 401k. And let's say there's, I don't know, $1 million in it. Cash it out, you pay tax on $1 million, so that bumps you up into a very, very high tax bracket. Then you can put that cash into it. You lose a lot of money. That's not efficient at all. And then the last question I just mentioned earlier, do you really want to do all of this just so you can go on Medicaid? Next question. Well, maybe I'll do a Miller Trust. I don't know if you're familiar with Miller Trusts, but Miller Trust allows you to qualify for Medicaid from an income. Remember we said Medicaid, they look at assets and they look at income. Miller Trust helps to isolate income from Medicaid. And I will tell you, like if you go to YouTube or TikTok, you will see a lot of estate lawyers promoting Miller Trust as like the really great thing. And again, I'm not here to comment if it's good or bad, but there are a lot of things that you have to consider. One of them is Miller Trust. Most states allow it, but if you don't, it does not help with assets. It only helps with income. A fair amount of states actually have maximum of how much you can put into this Miller Trust. And when you start to transfer your income into a Miller Trust, you only receive again that personal needs allowance, right? About $75. Goes up in some states. I think it's higher. California, I want to say, is higher, closer to $175. If you have a spouse not needing a care, they're allowed to kind of exclude some money out of that. But here's a big one. The trust the state is named as the beneficiary of that trust. And again, this is an irrevocable trust, meaning that upon the death of the recipient, everything left in the trust goes to the state. And these same thing, you do two things with these. One, you have to set them up, so that's a little bit of a cost. Sometimes it can be, fairly significant. Miller trusts are a little bit easier to administer than an asset protection trust, but there still is some ongoing yearly fees with these. And then again, do you really want to do all of this? Set up a second trust now, right? So just so you could qualify for Medicaid. Mike probably knows better than I do, but a lot of the better facilities, if you say, hey, I want to get in your facility and Medicaid's going to pay for it, they may say, well, we're more private. If you have long-term care insurance, we'll let you in, but if you're Medicaid, we may not, welcome you.
That's a really good point, Bill. And actually, the way that works, here's a little insider information for agents. In most cases, the scenario that Bill just mentioned is how it plays out, and that's why you can see his couple, Bob and Carol Davis, pondering this here in this picture. Now, here's the way that it can be maneuvered around in most states. If your client is in a facility on a private pay basis and their funds run out, they will just designate that bed as being a Medicaid bed. They can't force them out of the facility, okay? But that means they're going to have been in their private pay for at least 6 months. And all of the gymnastics and stretching exercises and Pilates that Bill just ran through that people are going through to qualify for Medicaid are specifically designed not to spend, their concept seems to be that they don't want to spend any of their money on this, okay? And I think most of you are looking at this and saying, okay, you know, what can I do about this? And there are a couple things, and Bill will get into some more of it here in a minute, but the biggest thing that you can do is understand it and really get your head wrapped around this idea. Think about, pick a client that you know had a significant health event, okay, and the coverage that they had through Medicare and a SUP or Medicare Advantage, whatever it was, how much the out-of-pocket was for them, all right? Okay, and where I'm going with this is the single biggest exposure they've got to all of their money is the one thing that as an industry, we don't do a great job of trying to help them with. We cover the health part of it, but the health part of it really is pretty minimal once you take those pieces parts. The part that's not minimal and can happen instantaneously even before they get their trust and all their Miller stuff and everything else going on, the big cost item is the care cost. And if that happens unexpectedly, and that happens a lot, you're talking about minimum $30,000 in the first 90 days, all out of pocket, 30 grand. And I can almost assure you that unless you got clients that don't have any coverage at all, you can't point to a client of yours that has had to spend that kind of money out of pocket. There are great resources. Bill's going to go into some of it here in a minute. There's other resources that you hear us talk about in different frameworks. There's ways to help your clients solve this problem. And if you ever have to have a conversation with Carol Davis, and that's Carol with that nice, I guess that's a peach sweater that she's wearing there, or some other color that I can't describe. If you ever have to have a conversation with her after Bob Davis unexpectedly had a health event and they didn't have all the gymnastics stuff finished, you'll understand what I mean, because the impact on their entire world, but particularly the financial part, that impact is nothing less than catastrophic. Go ahead, Bill.
Yeah, thanks. And Mike mentioned like, hey, there's other ways to help out. And you see here, I said, if is there only a way to pay for long-term care costs with discounted dollars? And by discounted dollars, I mean, hey, you're paying, a lot less into some sort of premium to get a bigger benefit out of it. So let's take a look at that now. So I'm going to look at two approaches. The first one I'm going to look at is a standalone long-term care policy. Then secondly, we'll quickly look at using a life insurance policy with a long-term care rider. So, and in this example, and right now we're looking at a standalone policy, we're going to have two couples. We're going to have the shorts and we're going to have the longs. The shorts, as you can see by the picture, they decide, hey, they're going to self-insure, or they're going to rely on some sort of government assistance program. It probably doesn't happen. So shorts are going to self-insure. The longs are going to work with you as a long-term care agent, and they're going to get a policy. So both couples, by the way, I'm assuming they're age 55. Again, the longs get the long-term care coverage, and I ran them at Select. And just so you know, at Mutual of Omaha, Select would be equivalent to standard, if you would, if you're looking at on the life side. So and I put together really like gold standard, if you will, policies. And just for the example, Mike mentioned it earlier, right? There's a lot of ways to do these things. So you could have any size policy. It doesn't have to be this in depth, but this is good for descriptive purposes. So in here, both husband and wife have $6,000 monthly benefits, so $12,000 total, or for 3 years, by the way. So that's $432,000 for both of them. 100% home care and assisted living, $1,500 cash benefit. 90-day elimination period, right? It's kind of standard. You can go up or down, but that's pretty standard. I also ran this at 5% compound lifetime inflation with share care. The combined premium of this is a little over $13,000 annually. So really nice policies, give them good peace of mind. So when these two couples reach 80 in 2050, we have a cost of care calculator that's on our website under long-term care. So the estimate on the national average for cost in a facility, semi-private room, 3% inflation, is about, again, in 2050, is about $228,000 per year. That's $625 per day in 2050. So at age 80, the longs, right, the ones we have the policies on, their benefit pool is $731,450 each, right? Because remember, we did that 5% inflation protection. That's a lot of money. They're in a good place. So won't go, just going to jump right to the chase. If both the longs and the shorts were in a facility for 3 years, both of them, again, right, I'm kind of, illustrating it, worst case, the shorts, they would have had to pay $1.4 million. That's a lot of money, $1.4 million. The longs, their out-of-pocket expense would have been $452,000. And the breakout of it is as well, they paid premiums for 25 years, $327,000. Then they also had that 90-day elimination period. So about a third of what the shorts paid. And think about the longs. When you get older, right? If when you speak with older people, you probably get a good appreciation of this. Older people, quite often, what's most important to them is to be able to leave money to their loved ones, right? Their kids, their grandkids. Guess what? The longs are in that position. They'll be able to, whatever assets they had, they'll be able to leave. The shorts, who knows? There may not be nothing. There may be negative for them. So we talked about discounting dollars. Hopefully you see that. And do you really want to self-insure? You're really exposing yourself, and you're exposing your kids and grandkids potential some of their inheritance money, if not all of it. So again, there is a cost of long-term care, but is it really over, in this example, almost $1 million, or is well over $900,000? Is that the risk you want to take, right? You always hear it in our industry is you want to insure what you cannot afford to replace. Something like this you can't afford to replace. You may not just have that kind of money. So this is where, when you buy insurance, this is where you buy it, when you can't afford to replace or you can't afford to pay for it. When you go to Best Buy and you buy a TV and they say, do you want the protection plan? No, I could afford to replace the TV, but I cannot afford potentially these long-term care costs in the future. Question comes up a lot, right? Well, what if I don't need the care? I don't want to spend all the money on the premium. Well, look, we're not talking about it today, but our policy and a lot of other policies out there, they have return of premium riders on them that you could put on there to get portion, sometimes all of the premium money back. So that's a strong option. Another option is if people are saying, hey, I just don't want to pay all the premium and if maybe I don't need it. Well, now we could look at a life insurance policy with the long-term care rider. And so now we're transitioning from the standalone policy, and let's look at a life policy with the long-term care rider. I'm going to use the same couple, the longs, right? The ones that got the policy. This time, instead of getting a standalone policy, they get a life policy with a long-term care rider. Our Mutual of Omaha policy, great policy for this, is called Life Protection Advantage. Both of them get a $1 million life protection advantage with the 4% rider, so they could get $40,000 monthly benefit for long-term care if needed. I won't go through all the math here, but I will tell you, these policies are much more expensive than the long-term care standalone product, right? Look, the premium just for Joe is $15.5 per year, and the premium for Chris was about $12,740. So you can see higher costs. And here it is right here. So standalone policy costs about $327. The life policy with the rider costs $790. But if they used, and I'll just go back, in this situation, I'm assuming that they both used about $535,000 of benefit for long-term care. When they eventually pass, the remainder of the death benefit goes to their loved one. So in this case, it was about $1.2 million. So much higher premium policy, but it also has the death benefit as well. A lot of times when we're talking about this, people say, oh, which one's better? Which one should I get? Every situation is different. Every situation is unique. For us as insurance professionals, as insurance agents, it's really important to know both and be able to have meaningful conversations with your prospects and clients so you could help them decide which one is best. So again, the same example, the shorts, right? Self-insurance, 1.4 million, somehow they got to figure out how to get it. The longs, if they had the life insurance policy with a rider, it would have been about $900,000 that they put into it, but they got their full long-term care protection, and they also had over $1 million of death benefit protection. So they still come up much better than the shorts did. All right, so Mike mentioned it earlier, and now, by the way, I want to transition back to the standalone policy. And Mike mentioned it earlier, partnership programs. So partnership programs essentially are, if you have a long-term care policy and it meets the definition of a partnership program, which most of them do, whatever benefit amount you're paying for, that amount of money you get to keep, even if you exhaust the policy and then you go on Medicaid later on, and Medicaid pays, right? Mike said it's a great strategy to get into a really, really good facility, and then Medicaid would take over. That's what you get to keep. And one thing, I put a little note there, sales idea. When you have conversations with your clients, I would suggest don't talk about asset protection. That doesn't mean a lot, but maybe have a more meaningful conversation and maybe say, hey, Mr. and Mrs. Prospect, I know you've got some kids and grandkids. Is it important to you that you be able to leave some money to them? Again, older people, 9 out of 10 times will say, yes, it's very important. We want to leave a legacy. So you can tell them, well, look, if you have a partnership approved program, long-term care policy, you could actually, regardless if you're in a facility for a long time and Medicaid starts paying for it, whatever your pool of benefit is, that money's protected. So if you have a $400,000, pool in your long-term care policy, regardless of how much eventually gets paid out to the facility, you'll leave $400,000 to your loved ones. That's a very impactful conversation, emotional, and it may help people understand why they want long-term care insurance. The other thing I want to mention, another sales idea, again, talking about the standalone policy, typically standalone. For us, it's standalone for most carriers. Tax treatment of long-term care premiums. It says benefits there. I'm sorry, it should say premiums. So individuals can deduct the premiums they pay for long-term care insurance, assuming if they added all their other medical expenses up, if it's over 7.5% of their adjusted gross income, they could deduct those premiums. So pretty good, but they have to exceed that 7.5% threshold. But check this out. This is where it gets real good. Self-employed businesses or owners or C Corps. Think of anybody that owns a business, right? Or a portion of a business. They can deduct the premium typically up to the eligible age-based premium for owner spouses, dependents. For employees and employee spouses, they could actually deduct all the premiums, even if it went past the age-based eligible premium. But the reason I bring this up is this is a really, really big deal. There's a lot of business owners out there. And by the way, this doesn't have to be like a full-fledged business. It could be a side business. You know, the example I use a lot is maybe somebody has, you know, they sell on eBay or they sell on Etsy and they're just doing it out of their house. If they're, you know, paying taxes like a sole proprietor or maybe an S corp or partnership, right? They are a self-employed, so they could run these premiums and get the deduction through their business, if you will. So if you're not up to speed on this, we've got a tax brochure on it we could get out to everybody with respect to long-term care. But this is a great selling point. You cannot do this with, you know, life insurance and generally disability insurance. You can't do this. Long-term care, because it's actually treated as health insurance under HIPAA, you can actually deduct premiums, which is really, really nice. So another thing I want to talk about in a sales tip. What if you're meeting with a couple and one spouse qualifies, but you know the second spouse won't, right? Maybe they just, because of their health, for whatever reason, you know, they're not going to qualify for insurance. I've seen it in the field a lot. You know, people say, well, unless we both get it, neither of us are getting it. Well, there's a way around that. So let's talk about that. So one way around it is sometimes it's called the long-term care trust. That's just a kind of a light, loosely used name. But the way it works is you get a LPA, that's the life insurance with the rider. You get it on the healthy spouse, right? The one that qualifies. So now you have the healthy spouse covered. And in the event, right, that he or she dies first, then you have that life insurance proceeds are paid out, and you can, you know, make your wishes known to your loved one and say, hey, use that pool of money to provide long-term care coverage for the non-healthy spouse. So so now you're protecting the non-healthy spouse, and in the event that the healthy spouse does not die first, right? Well, then he or she hopefully is there to at least, you know, provide some level of care to the non-healthy spouse. So is it as good as two policies? No. But let me tell you, it really, really helps, you know, as you're talking through this, say, hey, we can actually take care of this issue. Let me explain how we can do it. And it's a great idea. And by the way, if the coverage, if the long-term care isn't needed, then the death benefit goes to the loved ones. So just one more sales idea before we go. So I just want to say, you know, you guys all and the insurance company, the carrier, whether it's us or another one, you do a lot more than just, you know, provide ways to help cover long-term care costs with discounted dollars. But I mean, care coordinator, right? And you're probably familiar with care coordinators that the insurance companies provide. They do a really, really good job, and it's hard to understand how impactful the service they provide to your clients in times of need are. So they make sure there's no duplication of benefits. That's not so important, but they provide assistance. You know, hey, what does Medicare cover? What don't they cover? They provide the care coordinator, you know, help with bed reservations, respite care, alternate care benefits. They do a lot of things. So I just want to show you a case study that we have. So it happened to be a retired advisor that had Parkinson's. The spouse was declining. You know, wasn't covered with Medicare, but they had a policy. The care coordinator, who's a registered nurse, put together a very comprehensive plan of care. Underwriting was always there to answer questions for the policy owner and the spouse. And anyway, to make the short story long, here's what the policy owner said: you're a lifesaver, or the spouse of the policy owner, you're a lifesaver. You're wonderful, great, helpful, and the company should never let you go. Way to go and great job. What that spouse really said was, I don't think I could have done this without you, Mr. or Mrs. Care Coordinator. So that is another benefit of long-term care. Again, not just with us, but with most providers. That care coordinator will step in when that spouse needs help the most and make their life easier. So also use that as a talking and selling point with long-term care coverage. And just wrapping up, this is our advanced markets team. There's myself, Michelle, and Ron. Our info is there. More than happy to help out with any questions or any case. We really love jumping in, and so does Maria. She does a great job as well. So yeah, Mike, that's all I had. I don't know if there's any questions.
I've been handling them as we're going along.
All
so
right, perfect.
we're in good shape. We'll be doing some follow-up. So, all right, so I'm sure you're sitting out there in the audience going, okay, so now what do I do? All right, how does this help me? Well, take a step back and look at the bigger picture of what it is that you do, okay? And our job is here at AIM, and Mutual is a big contributor to that. Our job is to make sure that you have ideas and solutions to do a better job of taking care of your clients, helping more people all the time, okay? And we just spent a long time talking about an absolutely staggering risk that the greatest majority of the clients that all of you together and individually work with, this is a staggering risk that they face. Along the way, the primary business that we do, Medicare Sup, Medicare Advantage, that's going to become more and more commoditized. The market is going to force that to happen, which means it's going to become more and more about price, okay? In a lot of states very soon, and in other states in a year or two, you're going to see baseline prices for Plan G supplements higher than they've ever been, and continuing to go up. That's going to push people to Plan Gs. Or I'm sorry, not Gs, I'm sorry, Plan Ns and high deductible Plan Ns. And those don't pay a lot of premium. They don't pay a lot of commission. All right. Along the way, you working with us and taking and embracing these other opportunities gives you the best chance to be of value. One of our marketers here always talks about how the primary thing they try to do every day is to be of value to agents in the field. We want to do that, and we want you to be able to do that for your clients, okay? As you look at all of this, remember, this is a different one of our marketers here, came in the door when they joined the team a while back, said, you know what, the best policy, do you know what the best policy is? The best policy is the one that's enforced. So keep that in mind. Great doesn't have to be the enemy of good. Bill gave you some great ideas and some great ways that we can solve for this, but there are going to be people that don't have the wherewithal or maybe the commitment to go that far. We've got other ways to help your clients solve these problems. Unfortunately, in Washington, and I know a large number of you are from the state of Washington, we can't have nice things in Washington, and so some of our better solutions aren't as readily available there. But there are others of you from all over the country. We do have different ways that we can help you work with your clients to make sure and take this staggering exposure and offload it somewhere else. Bill used the term discounted dollars. That's what we want you to be thinking of, and to be thinking about increasing that stickiness, that value proposition that you make available to your clients by virtue of talking to them about these things. And you may not think so, but the awareness of this particular thing is higher than it's ever been, because these people that are your clients now are coming out of situations where they have been through this with their families. So they know about it. They just don't know how to solve the problem. We can help you with that. So, all right, Bill, we got all the questions handled. Maria, thank you for joining us. You're an invaluable resource, and we appreciate all the things that you do to help us out. Bill, I appreciate you joining me again today. I'm sure we'll be back here in touch in a month or so, and we'll come up with some other new cool thing to bring out to agents to show them that we're constantly looking for ways to help them help more people. I'm going to let everybody else go. We appreciate you joining us. We'll be in touch with any follow-up questions, et cetera, here later today to make sure that you come out of this feeling like you've got options to help people. So with that, we're going to sign off. Thanks, Bill. Maria, Jordan, thanks for all your help, of course. We'll talk to you later. Bye now.
Bye-bye.